Hello to everybody, and thank you for the introduction. Today I'm going to talk about how we can enhance macroeconomic forecasting using RavenPack Analytics. So basically, with the RavenPack Analytics, we have two approaches. The first one is one that Peter told this morning, and is how we can build macroeconomic indicators to describe economic dynamics by simply using our filtering and our taxonomy. And an example was the TSI indicator that Peter introduced this morning. The second way how to use RavenPack Analytics is to create thematic indicators to forecast directly macro variables. And I'm going to focus on this second point, because the first one has been touched already this morning. So what are the main features of RavenPack Analytics, what they have, what we can use on top of classical macroeconomic data in macroeconomic modeling, of course. So first of all, it's timeliness. So RavenPack Analytics are available at high frequency, because they are daily, and we can have also like a feed during the day, not just like at the end of the day. They capture current narratives related to specific topics. As Peter mentioned this morning, we are going more to building thematic indicators, so to capture different thematics for equity, for ESG, and also for macroeconomic events, because there are different themes that can affect economic growth, different themes that can affect inflation, different themes that can affect the labor market. And also, like our colleague Akash today has introduced the link-up dataset. And then there can be early indication of how the macroeconomic variables are evolving. I'm going to touch that later. Another point that looks in favor of RavenPack Analytics is the flexibility of the data, because we can produce, using our taxonomy, multiple thematic indicators. The time horizon of the aggregation can help us to target different frequencies. So if our target variables is quarterly, monthly, weekly, or annual, using rolling averages or decaying factor, we can aggregate the variables to match that frequency. And then we are not dependent from any statistical office. So we don't have to wait when the statistical office is going to release an official figure, because we rely on news. And basically, all these features can help to overcome some classical macroeconomic issues related to macro data. Most of the time, well, always, there is imperfect knowledge about the present state of the economy. That is due to the second point, that is the delay in releasing the key analytics. So GDP is with usually 6 to 8 weeks of delay, inflation a couple of weeks, production variable usually they suffer about 3 to 5 weeks of delay. And using RavenPack Analytics, we can overcome this issue. I want to introduce two applications that we have been working with my team during this year. The first one is NOWCASTING economic activity, and the second one is how to produce timely inflation prediction for investing. So that is also like we did an actual application using our prediction. Let's start with NOWCASTING economic activity. So in order to nowcast economic activity, what we did, we built this nowcasting automated machine. The nowcasting automated machine, it starts everything with a new data release. So if something is happening, the machine starts and works and produces, it updates. If we don't have any data release, the machine is not working, because our best guess for tomorrow, if we don't have any new information, is the guess of today. And what triggers the machine is the news. The news, this is like a slide, I want to make like a slide different. It's not the news like on the newspaper, but it's actually the difference in what the machine was expecting and what the machine is receiving. So for example, machine was expecting a declining industrial production point, while instead industrial production release was positive. That's the news that triggers the machine. Once the machine is triggered, the model runs, it updates the factor. Machine, it relies on a dynamic factor model. I don't want to get too much into the details, but it's a dynamic factor model estimating using expectation maximization algorithm. So it relies on Gaussianity and linearity. And we produce model forecast, an nowcast index, and then everything is stored. We stored also other series nowcast update. So the GDP that I'm going to show you the results, it's just an application. The model contains many other series like unemployment series, production series, consumption series, and we produce the prediction also for those macroeconomic variables. We simply use GDP as a reference to evaluate the goodness of our model. I have an academic background, so GDP is the most used applications. I'm a little bit biased in terms of like showing the variable wise. So what we do first is to identify, of course, macroeconomic variables, so the core macroeconomic variables, and then we create timely macroeconomic thematic indicators using RavenPack Analytics. This is a sample for the US economy. So the pie chart tells you how the news analytics for the US economy are divided. And as you can see, more than the 25% is interest rates news, because that's the hottest topic that is related to the to the US economy. Then we have employment, because there is a lot of talk always going on with jobless claim, NFP, JOLTS, and so on. And then we have domestic product, because GDP is talked in the news, especially when there are central banks or statistical offices or also analysts that cut or improve the forecast for a specific GDP of a specific country. And then we have public finance, consumption, and so on. What we do is to identify what are the macroeconomic fundamentals that can drive the economy. So we believe that the main driver of the economy for the US are, of course, interest rate, unemployment, GDP, consumption, and production. And so what we do, using the specific filters that are easily, you can easily manage through our platform and also through our APIs, we select only the most important data. We try to eliminate some noise in the data, because there can be data that are noisy due to temporal analytics, data that are noisy because some of the sources are not too reliable. So we get rid of most of the noise because we are interested in building precise and leading indicators. So that's what we want to create using thematic indicators. And we construct daily indicators aggregating over 30 and 90 days. One of the features of our data is that we can split. This morning, Nicolas Mangier has talked about that, about planned event, expected event, and unexpected event. And so basically, we can split our data between fact and guidance. Fact are news that talks basically about what has happened, while instead guidance, they're more leading news that talks about what can happen in the near future. So it's just like a sort of expectation that people can have. So we can create those two different type of indicators using our analytics. After we create indicators, of course, before selecting which one to include in our model, because we can create many of them, this is just like a visual analysis to show you that the RavenPack analytics the RavenPack indicators that we create at a daily frequency, the red line, they follow closely a slow-moving variable like GDP, that is the white line. This is simply a visual analysis. What we ask ourselves is, are those variables, those sentiment analytics, actually useful to predict the GDP? So they can actually enhance a classical statistical model that use only macroeconomic indicators, for example, industrial production, retail sales, and so on. So from this analysis, we take macroeconomic variables, we take our RavenPack thematic indicators, and we plug them into our NOWCASTING framework. And this is the results for what concern the US GDP, so the US economy. What you can see on the right side of the slide is the root mean square forecast error that starts basically 6 months before the actual release, so 180 days to 100 days before. The forecast period is the prediction of the next quarter. The nowcast period is the prediction of the current quarter, while the backcast period is the prediction of the past quarter. We can do that because GDP is released for the US with 4 weeks of delay. So we can actually improve on our prediction also over those 4 weeks. So we can still include variables until the day before the release. And what we can notice, we basically compare two models. The blue one is a simple autoregressive model, so that's the worst one. And then we create like a nowcasting benchmark model, that is the green line, that uses only macroeconomic variables. And we use the same model by adding RavenPack Analytics, that is the red line. So what we can notice is that in the forecasting period, the model that uses RavenPack Analytics overperforms the benchmark that doesn't. And then also in the second period of the nowcast until the day before the release is actually more precise. What we use basically RavenPack Analytics aggregated over 30 days. We use both CSS and ESS because what has been said before in the previous presentation, CSS is a little bit slower than the ESS, and so we take advantage by using both of them in terms of timeliness and accuracy. And then we focus mainly on indicators that refers to GDP, employment, and consumption narratives. And we use both aggregate and guidance, so leading and also current indicators. How to select the indicators? We look at the historical correlation with US GDP. We look also at how they adapt closer to turning points, so closer to recession and recovery, and then if they actually improve the out-of-sample performances. We did like an extensive application, so we haven't just like focused on the US economy, but we applied the same machine and the same technique to create these RavenPack thematic indicators to Brazil, Russia, India, South Africa, China, and the US. And what you can see there is the evolution of the root mean square forecast error through 30 weeks before the release, 26, 20, 14, 8, 4, and 1 week before the release. And what you can see, the bold number, I'm sorry that the last line it's white, but still it's the worst model, so don't worry. The bold numbers is actually when the nowcasting model enhanced by RavenPack Analytics improves on the nowcasting model that uses only macroeconomic indicators. And you can see that basically over all the countries and over all the periods, the model is enhanced by using RavenPack Analytics has better performances in terms of root mean square forecast error. So this is the first application that we did. We are planning to extend the country coverage, and we are planning to extend the output of the model because we have a daily indicator of the economic activity. As I said, GDP is just an application. We are planning to use that in order to show how we can use as we did for the THESI. So like in some sort of like asset rotation, but also since we are implementing many countries, doing like country rotation and country asset allocation in order to show on which are the best performing countries. Timely inflation prediction for investing. So the other, since it's a really hot topic nowadays because people, they forgot about inflation for almost 20 years, except like few periods. It's inflation. So, and since I've shown you before, we have a lot of news related to interest rate and consumption and production. We wanted to use them in order to create timely prediction for inflation. This is why inflation has become more and more important. So basically, what you see, it's the CPI headline and CPI core inflation in year on year from the 60s until September 2022. And basically, you can notice that there are different regimes in terms of volatility and mean. Here I put the mean value for CPI headline and core. It was about 5% from the 60s until the Great Moderation, 1984. Then I put the value of like 2.6% for both. That goes from 1985 until the beginning of COVID, basically. And then the mean value for the last 2 years. That what you notice is that basically we are going back to the period before the Great Moderation. So with very high level of inflation, and this is concerning because there is more uncertainty, there is more volatility, and this affects everyone. It affects investors because they have to understand how to invest their money, and it affects most of all consumers. We are all consumers, so it affects our daily expenses, it affects our grocery, it affects our medical bills, it affects our transportation cost. And so it's a rising concern for everybody, not just for investors. So central banks and also practitioners. So what we do, these are some stylized facts about inflation. So usually, high inflation uncertainty erodes current and future growth. So all the people are concerned about that. Then central banks intervene to guarantee price stability and steady growth. So that's what the central banks want. So steady growth, always a solid 2.5% for developed countries, and price stability, so where people can actually invest, can actually take loans, can repay their loans, can buy a house, and it can actually improve their lifestyle, their consumption preferences as well. But in those regimes, especially for practitioners, the asset allocation is challenging. And so what can be the solution? We believe that the solution are three ways. Having all of three together is the optimum, but you can also have like two of them. First of all, especially from an investor perspective, you need to have a good modeling. So if you can actually anticipate what's going to be the next inflation regimes, where the inflation is going to go, it's a good indication. It's a good tool for you in order to act before the other people are acting, or before the central banks is rising or decreasing interest rates. So it's going to place you in an advantage position. Second, of course, you can have the best model ever, but you need good data. You need like a good source of data, timely data that are not noisy and that are telling you good narratives, where the economy is going, what people are thinking, how people are going to react. So the first two ingredients are fundamental, together because you can have the best machine ever, but if you don't have like a good fuel, machine is not going to work, and the other way around. You need to be able as well to process your data. You cannot just believe that you just take a data set and find some hints, because data today are getting like more and more complex. They contain a lot of information, and it's very important to find the right information to use. And finally, I put a barrel of oil, a stylized barrel of oil, because it's very important for an investor perspective, understanding which asset class to invest. There are some stylized facts in some papers, one from Harvey Campbell, that analyze different regimes of inflation and says which are the most important asset class to invest if we are in a deflationary period or in a hyperinflation period. So that's finance literature can help in order to understand which are the best asset classes, but also like years of experience in this field is actually like a good tool in order to understand that. And what we did, as for the nowcasting model, we built a model that relies on macroeconomic data and RavenPack analytics. This is just a zoom from early 2020 until September 2022, in which we plot 5 different thematic RavenPack indicators that we use in our model. These are not the only 5 indicators that we use more, but just to give you an idea, not to overcrowd the chart, we show the unemployment, economic growth guidance, consumer price, inflation, and interest rate. And what you can see, basically, it follows what the narratives that people are talking. So interest rate during COVID, they got reduced by the central bank, so you have like a drop in the white line. They are actually basically steady, and not a lot of people are talking about that through all the COVID recovery. And then people are start talking about central bank increasing interest rate. At the end of the year, people were just talking, but the central bank was not raising interest rate, so it gets steady. And then at the end, with the new year, the Fed starts to raise interest rates, so the sentiment spiked towards like a positive area. And the same for the economic growth guidance. You see that it declines during COVID because GDP was declining. It recovers pretty strong during the following year. And then, due to the hyperinflation regimes, due to the increase of the interest rate, increase of inflation, economic growth guidance drops. But also in this case, as before, those are simply, it's a simple visual analysis. We want to understand if those indicators, those variables, are actually helpful in producing accurate prediction for inflation. And what we did, we create a model. It's a Bayesian neural network model that uses RavenPack analytics and macroeconomic data together. And it produces a forecast for inflation for the next figure of inflation. Then we, using the model B1 and B2, what we do, we define our strategy. So we do not focus our attention only on the average prediction of inflation, but we want to understand in which regime we are. So we basically map our inflation prediction into a regime of inflation. And we define only 3 regimes: low inflation regime, normal or medium inflation regime, so that's the central bank target basically, and a high inflation regime. So when breach a certain threshold. And then, in order to understand what is we call it commodity weight, but it's basically an hedging component. So how much of our portfolio we need to invest in the commodity in order to protect ourselves of a low or high regime of inflation. It's a very simple linear model in which we use our inflation prediction and the commodity price that we are using in our strategy. So all those ingredients, they all start from the prediction of the inflation rate month of month using RavenPack Analytics. So if the prediction is poor, we will obtain poor performances. If the prediction is good, we are also able to achieve good performances. And how we set up our backtest or out-of-sample exercise. So we do a monthly asset allocation that depends on our inflation forecast. We do that for both CPI core and CPI headline for US. We use 3 different asset classes. Equity, we use the S&P 500. We use the GSP as a global commodity index. And then we use the US T-bill as a fixed income component with 1 month maturity. Our backtest goes from the January 2008 until August 2022. And it's fully out of sample. And we have two weights in our strategy. One is the equity weight that depends on the inflation state. And for this, as of now, we are using a rule of thumb that comes from the literature. We are also we are working on, actually, in order to properly identify the weight of the equity component without taking any assumption. But as of now, in this application, we are using this rule of thumb. And so if the inflation is in state 1, so in the low state of inflation, smaller than 1%, we split 50% of our investment in equity and 50% in the hedging component that is made by commodity and treasury. If the inflation is in the normal state, so central bank target, we invest everything in equity because historically is the one that has usually performs well when the inflation is under control from the central bank. And then if the inflation is in state 3, so it's an hyperinflation regime, so it's above than 4%, we invest 100% in the hedging component. And then within the hedging component, we have to determine the commodity weight. And the commodity weight is determined, as I said before, using that simple regression of our prediction over the commodity index return. This is the performance, the real annualized performance with the CPI core. Real because it's the net of the inflation rate. And so what you can notice, we can achieve a 0.72 Sharpe ratio with respect, so we basically more than the double than investing only in S&P 500. And especially we actually gain when inflation is a hot topic. So in 2015, there's the separation with the S&P 500 because it was when the Fed started to increase interest rate after a very loose monetary policy from the financial recession. And also during COVID, it's basically pretty flat, the performance, because we can understand the low inflation regime. And then it actually improves in 2022 when we get into the hyperinflation regimes. And so our model with RavenPack Analytics can outperform the benchmark and also the 2 passive alternative strategies that are the so common 50-50 and 60-40 equity bond and equity portfolio. This is the output of our model. That's just the application of the strategy. This is the output of our model. So what we predict the inflation forecast, that is the green line. We predict the regime of the inflation, that is the white dot. So you can see on the right side is state 1, 2, and 3. And so what you can notice is that already in March, we are predicting a low inflation regimes. Why? Because we've seen that RavenPack Analytics come in very helpful in declining when COVID hits, way before the official release of the number. And then also from June 2022, we are predicting a high inflation regimes. Why? Because also in this case, RavenPack Analytics come in very helpful because they are, for example, growth is declining, but interest rate, inflation expectation, and the other variables that I've shown you, they are actually going into like a positive territory, meaning that the risk of a higher inflation regimes is higher. And on the left side, you can see the actual weights of the portfolios between commodity, risk-free, and equity. Finally, this is the application to the CPI headline. For the CPI headline, we are actually able to achieve a higher Sharpe of 1.104. This is basically because a drawdown of minus 26 with a volatility lower than the one of the Standard & Poor's 500, and this is due to the fact that CPI headline has it's a little bit more sticky and has a little bit of more trends, short trends, with respect to the CPI core, which is sometimes it's very volatile, and especially in 2008, 2009, it hasn't been affected too much because the shock there was due to the oil prices, basically. So finally, from what we are still working on, we are planning to extend to multiple countries, also the inflation exercise as the nowcasting exercise. But what we have found today, after like a year since like last symposium, since last year, is that nowcasting real economic activity using RavenPack Analytics improved the performances for many countries. So not just for the US, where we have more information, but also for emerging economies. Why? Because in emerging economies, we have less macroeconomic data. They are less timely. For example, for South Africa, you have to wait like 60 days. Unemployment is even quarterly, it's not even monthly. And RavenPack Analytics can come in very helpful for those countries where you lack information because they fill a gap. Second, RavenPack Effect taxonomy that Peter has talked about this morning, it's very helpful to create granular and thematic indicators that can capture specific stories, specific events, and you can build them in order to insert in your model what you believe is driving the economy or is driving inflation, or it can affect, it can impact the economy. And finally, building also automated strategy, because we didn't add any human overlay. We simply just what the model says. We didn't use any human overlay. So implementing strategy using RavenPack Analytics, it can improve over passive strategies or in which you simply allocate your portfolio in a very static way.